welcome to our Cost Segregation Software Tools and Tax Strategies webinar. Today's speaker will be our manager from our Pasadena office, Arthur Badley. We like to begin all of our webinars with a little background on our company. KBKG is headquartered in Pasadena, California, with additional offices in Illinois, New York, Georgia, Texas, and Pasadena. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineers and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RS means and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax related issues, including 1031 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. Now I'll introduce our presenter, Art. Based in Pasadena, California, Art is a manager with KBKG for the cost segregation practice and primarily oversees the West Coast region. He consults with business owners and tax preparers on strategies to reduce their tax liabilities, utilizing cost segregation, asset retirement, repair and expense, fixed asset reviews analysis. He joined KBKG in 2015 and has experience conducting cost segregation studies ranging from restaurants, hospitals, hotels, large retail centers, heavy manufacturing industrial facilities, multi-million-dollar offices, and residential complexes. He manages daily operations with a team that strives to achieve excellence in all aspects of the industry. He is also responsible for training staff, spearheading software matters, preparing proposals, and providing presentations on continued education. Arthur earned his Bachelor's of Science in Civil Engineering from the California State University, Los Angeles. He is also a member of the American Society of Cost Segregation Professionals. Now I'll turn it over to Art.
Thank you, Jackie, and welcome everyone. Thank you for joining us this afternoon. As Jackie mentioned, we do have our colleague Nathan in the background answering questions. So if anything is unclear, please feel free to put that in the question box. We would like to get started with some learning objectives for today's presentation. First of all, this webinar presumes the attendees have some basic understanding of cost segregation. I'm going to briefly discuss the benefits of doing a cost segregation study and mention some of the tax implications that you will need to consider in conjunction with these studies. I'm also going to discuss some tax strategies and planning considerations that you may not be aware of. Finally, I'm going to discuss some new proprietary tools created by KBKG that allow taxpayers to generate deductions, value for your clients, and even potentially generate revenue for your company. So, cost segregation has been around in one form or another for decades, although many taxpayers and tax preparers are unaware of it. The IRS, on the other hand, is well aware of cost segregation, and they even expect taxpayers to perform these studies. They published a Cost Segregation Audit Techniques Guide, or ATG for short, to assist examiners when auditing returns. You can view the entire Audit Techniques Guide on our website at the link displayed on this slide. The primary goal of cost segregation is to identify depreciable real estate related costs that can be depreciated faster, typically through 5, 7, or 15-year recovery periods, versus the standard 27.5 or 39 years. The secondary goal of a cost segregation study is to identify the depreciable tax basis for each major building component that is likely to be replaced in the future. Examples of these would include roof, windows, doors, bathroom fixtures, HVAC, and so on. You might ask why? Well, when a component is replaced, taxpayers can use that information to claim a retirement loss or a partial disposition deduction for the remaining depreciation left on the retired component. You may be wondering what types of real estate transactions are good candidates for a cost segregation study. Well, the most common type of analysis is for existing properties that were acquired by a taxpayer. In this situation, the depreciable portion of the purchase price is recovered over the appropriate recovery periods you see on the right. Next is newly constructed property, which is property that has been constructed and placed in service for the first time by the taxpayer. In this situation, the total capitalized cost of construction is recovered over the appropriate recovery periods. Many taxpayers also incur costs to remodel existing properties, and depending on the facts and circumstances, end up capitalizing these costs as well. The last most common type of analysis is for improvement to an interior space. This would typically include analyzing costs for interior tenant construction within an existing building shell. You might be surprised to know that a cost segregation study can be done on properties that were placed in service in a prior tax year. You can actually go as far back as 1987. However, the depreciation you can take on an asset is limited to that asset's remaining depreciable basis. So as a practical matter, it's usually most beneficial to focus on assets placed in service during the past 15 or 20 years. Let's take for example a $3 million retail building that's being depreciated straight line over 39 years. The result of a cost segregation study might identify about $330,000 of 5-year tangible personal property and another $360,000 of 15-year land improvements. Reclassification to these shorter recovery periods results in approximately $611,000 of additional deductions and an increased cash flow of $262,000 over the first 5 years. One thing to note, this example is a property in California, which takes 100% bonus and is placed in service in 2019. Cost segregation is one of the most common tax planning tools that should be considered by everyone in the cost segregation or in the real estate industry. I'm sorry. You can do the study anytime after the building is purchased without filing an amended return. You do this by filing a Form 3115 for a change in accounting method, which allows you to claim any missed depreciation deductions in the year you apply the study. So this is very important for taxpayers to consider. If you, on one hand, have the probability of a taxable event in a future year, you may want to delay the study until the year you are actually going to need those deductions. Without the software tools we are going to discuss today, it would generally make sense to hire a cost segregation engineer when there was a depreciable basis of about $750,000 or more. Otherwise, it's difficult to find enough benefit in the study to justify the fees incurred. For more updates on tax planning strategies for cost segregation, please see our updates posted at the link shown on this slide. So here's a list of some tax considerations that you should be aware of when utilizing cost segregation. Depreciation deductions will reduce alternative minimum tax or AMT. Bonus depreciation can apply to reclassified items in a cost segregation study of a newly constructed property and now also acquired property, and that's huge. We'll talk about that in the coming slides. Also, any unused deductions can carry forward to future tax years. When a building is sold, the taxpayer or seller may need to recapture depreciation taken on tangible personal property. Accounting method changes are addressed with the IRS Form 3115, which means you can retroactively address buildings from prior tax years, as I previously mentioned. Passive activity rules can offset the benefits of doing the cost segregation study. If the real estate activity is passive, then you must use the deduction against income that is also passive. 1031 exchange rules need to be considered. Typically, it's a net increase in depreciable basis associated with the replacement property that's the subject of a cost segregation analysis. The 100% bonus depreciation rate is applicable for assets that were acquired after September 27 of 2017 and applies through the year 2022. It is then scheduled to reduce by 20% each year after that. The new law no longer requires that the original use of the qualified property begin with the taxpayer, as long as the taxpayer had not previously used the acquired property and the property was not acquired from a related party. The opportunity to take bonus depreciation on acquired property is a very significant benefit that taxpayers have not had before. Taxpayers need to consider, or taxpayers that are considered to be in a real property trade or business must use the ADS system if they elect out of the limitation on interest deductions. However, this does not apply to businesses with less than $25 million in average revenue over the last 3 years. The ADS recovery period is 40 years for commercial buildings and 30 years for residential rental property. The result of the mandatory use of ADS is that bonus is not available to the taxpayer. The definition of a real property trade or business comes from section 469 small c7. Taxpayers electing out of interest limitations must use the alternative depreciation system recovery periods for non-residential real property and residential rental property. The good news is that this mandatory ADS requirement for taxpayers in a real property trade or business that elects out of interest limitations is specifically associated with these two types of real property. It does not apply to tangible personal property, and so 5 and 7 year property remain bonus eligible, even though ADS recovery periods apply to the real property categories I mentioned. Land improvements are interesting because we usually think of them as real property components as well. However, this type of 15-year real property is not considered in the definitions of non-residential real property or residential rental property. Therefore, land improvements remain 15-year property and they are bonus eligible. Although the law states that acquisitions after September 27th of 2017 are eligible for bonus depreciation, there are certain written binding contract rules that disallow bonus depreciation if an acquired building went into contract before September 28 of 2017. For example, assume a taxpayer closes on an acquired property on October 1st of 2017, but they entered into a binding contract on September 1st, 2017. It's likely that they are not eligible for any bonus depreciation on their used property. Remember, date September 27 of 2017, that's the key date. The final regulations provided some clarity on the acquisition date of used property acquired pursuant to a written binding contract, and that date is determined to be the latter of the following: the date on which the contract is entered, the date on which the contract is enforceable under state law, if the contract has one or more cancellation periods, the date on which all cancellation periods end, or if the date has one or more contingency clauses, the date on which all conditions subject to such clauses are satisfied. We highly advise our clients to consult with their attorneys or tax advisors regarding the binding nature of such a contract, as this may directly impact their eligibility for bonus depreciation. In section 754 step-up elections, as long as there is a new partner coming in and the property hasn't been used by the taxpayer before, the step-up can receive the new bonus depreciation. As I mentioned before, Step up on death is specifically excluded from the new bonus depreciation where the property is received from a decedent or a related party. Cost segregation can also be a useful tool in estate planning, actually. For this strategy, let's start with some basic rules related to estates that involve real estate. When a building owner dies and a property is inherited that has appreciated, any gains built up during the decedent's life are forgiven. The beneficiary receives a step up, which means the property's depreciable basis is reset to the fair market value as of the date of death, and depreciation starts all over again. Because of the step up, there is a time sensitive opportunity to apply a cost segregation study to the decedent's pre stepped up basis, which would create a permanent tax deduction. To illustrate this, let's look at a building that was purchased by a decedent in 2013, where the death happens in August of 2019. So, since the original investment of $1 million is considered residential rental property, it is being depreciated over a long life of 27 and a half years. And you'll see that in the illustration on the left. So by the time of death, the decedent will have approximately $728,000 of depreciation that he or she never got to deduct. The decedent's estate will still need to have a final tax return prepared for the period in 2019 that he or she was alive. Now, suppose the decedent had sold the property for $2 million before he or she died. That would have created a taxable gain of $1.27 million, right? But that doesn't happen in our situation though, since the current estate rules forgive any taxable gains built up by the decedent. The beneficiary, however, gets a full step up to the full fair market value of the property on the date of death. In this case, let's assume $2 million. The beneficiary now records the $2 million basis on their tax return going forward. Now, most taxpayers already know that doing a cost segregation study on the $2 million stepped up value is a great idea. But many tax preparers overlook the time sensitive opportunity to apply a cost segregation study to the pre-stepped up basis. This allows the decedent to claim even more depreciation deductions before death, lowering the building's tax basis and creating a higher step up to fair market value. The idea is to take as much depreciation before death, since the heir gets a step up to the fair market value regardless of the decedent's remaining basis. This strategy typically yields the greatest benefits for the estate because these deductions would otherwise be lost forever if not taken on the decedent's final tax return. In our case study, when the decedent's final tax return is filed along with a Form 3115, because remember, they acquired it in a prior tax year, they get to claim missed deductions of approximately $174,000. As I mentioned previously, this lowers the decedent's building tax basis, but that's okay because the heir gets a step up to the fair market value regardless of the decedent's basis. Now, because these deductions would have been lost forever, the result is a permanent tax savings of just over $68,000. Now, I mentioned that this study needs to be done on the decedent's final tax return. That's because when a building is acquired in a prior tax year, or in a tax year prior to death, in order to apply a cost segregation study, a Form 3115 is required and generally cannot be filed on an amended return. From the heirs' perspective, they get to now step up the basis to the current fair market value and begin depreciation all over again. And since they've already had a retroactive cost segregation study done on the property, they can now have the study quickly and easily updated to reflect the new fair market value step-up basis at minimal cost. This allows the heirs to maximize deductions on the new basis as well. Now, we are going to shift gears here a little and discuss some of the proprietary software we mentioned earlier. The residential cost segregator was created to provide tax preparers with a tool that allows them to prepare a cost segregation report on smaller residential properties without the need to hire a third-party cost segregation engineer. Using basic information and allowing the building owner or property manager to fill out a simple survey about the property details, our software provides a detailed cost breakdown for the property categorized by tax recovery period that can be used for income tax depreciation purposes. This is accomplished by using empirical construction cost data and proprietary algorithms written by the KBKG cost segregation engineering team. Most reports result in substantial deductions, and honestly, for some taxpayers, they are pretty sizable. The bases for these properties are lower, and the properties are smaller. But understanding the type of taxpayers that are likely investing in these opportunities, these could be quite significant, especially compared to the cost of the report, as you will see very soon. It can provide tremendous value. They are designed in a way that is easy to use, takes less than 15 minutes of time to prepare, and as I mentioned, it is a tool for taxpayers in a way where they can pass the questionnaire along to the property owner. The property owner can fill out the facts and do some of the legwork, and it will come back to the tax preparer, pretty much ready to the point that it just needs a quick review. Call it a sanity check before they hit the button and actually generate a report for themselves. It is a white labeled report, meaning there are no KBKG logos anywhere. So the tax preparer can simply put their own logo and really provide this as a value add service for their clients. It's something that they can even present to their client as another service offering, along with maybe the compliance and tax preparation work they are already doing. It does come with our free audit support. So KBKG does stand behind the work that we do. They are simplified so they can be easily uploaded into our 481A calculator as well. You can print them out in either PDF or Excel format, as I will show you in the live demonstration coming up. And as I mentioned, we do see tax preparers or CPAs charging upwards of $1,000 or $2,000 of their own professional service fees associated with putting these reports together. And that's the cost of our report and some of their professional fees to do some of the work. Very, very cost-friendly way for properties south of that $500,000 depreciable basis level. So as we jump into the live demo, we always recommend 3 steps when considering the residential cost segregator. First, go to your website, look at the product, and estimate the potential tax savings for your client for free. There is a little estimate box, so you can see if this is even worthwhile for you before you engage to complete this. Step 2, if you're interested in pursuing, you send that survey link directly to the building owner or property manager to fill out the property details. Step 3, it comes back to you, the person who initiated the survey link. You get to review the information, and you get the final say to actually pull the lever and generate the report and use up your remaining report credits. Then you have a cost segregation report complete with all the details you need to implement into the return. Step 4, and this is optional if the property is in a prior tax year. You have the ability to upload straight to our 481A software to calculate the catch-up deductions I was mentioning before. Now, bear with me, folks, as I exit out of this webinar and launch the live demonstration here. So just going to log in here on the right. I assume everyone does have a login information if you've joined this webinar. So as I log in, you'll see your software subscriptions up here. And you'll see that I have 75 residential cost segregated reports available. I'm going to click through that. Okay, we're going to do new report. So this is the first screen that you see, and you see here there's a button here where you can send an invitation link to the property owner or building manager, as I mentioned, and there's a template in there, with a link, and you're welcome to change that up, the subject, and design it however you'd like, and to your recipients you can put up top. So let's just run through one of these. Street, okay. So I'm just gonna put some random information to see, try to use the same dates. I think we used June 18, last one. And so what you see here is depreciable tax basis, in-service date, type of structure. Let's say this is a fourplex. Let's say a building square footage of 4,000 square feet, maybe 1,000 square feet per unit. 1 story. Let's say the lot is about 7,000 square feet. Exterior wall type, is a stucco, wood panel, brick. Let's do wood panel. Do you have a basement? No. Construction quality, average, high end. And note, these little question marks here kind of give you an explanation of what it's asking you in case you need more than just the exterior wall type. So, okay, as we go on to the next tab, it's asking you how many bedrooms and how many bathrooms. So we said fourplex, so let's just say 4 and 4. Are there fire sprinklers? And here, you or the property manager, property owner get to put the type of flooring. So let's say, in the kitchen we have vinyl, bathrooms we have ceramic tile, living room is carpet, dining room vinyl, carpet. Hallways are also carpet. So you even get to input the type of HVAC system. Is it heating, cooling, or both? Let's say it's heating only or cooling only in California. Is it in wall or ducted? Number of ceiling fans. Let's say there's a ceiling fan in each. The type of window treatments even. Let's do horizontal blinds. Down to the type of appliances that the units have. Let's say a dishwasher, microwave, and range. We're going to go to exterior, the type of parking garage. We'll say there's no parking garage here. And there's 4 driveway parking spaces. There's no pool, there's no patio. There is some landscaping. Any walls and fences. You know what? There's 50 feet of concrete wall, 50 linear feet. And there's no wood fences, right? So we're going to go into the next tab, tax benefits. You get to change the federal rate and your ROI factor if you'd like, the return on investment. Tax return year 2020. Is it bonus eligible? Yes, it is, 100%. Review. So when you send out that link as a tax preparer, and you get it back, this is what you'll see. When you click into that link after it's been filled out by the property manager, property owner, here's what you're seeing. Okay, so you get to do this sanity check, as I call it. Anything that needs to be updated, anything you feel is incorrect, you can do that. And the last thing, you'd hit the green button once you're done. So when you hit the green button, there's a disclaimer saying, hey, after you click this button, you'll use up one of your credits. Do you agree? Okay, we do. Okay, so here's our final results. You can save it as PDF, export to Excel, and you can even calculate the 481A adjustment. If you click this, it'll take you straight to our 481A software, upload all this information into there. You can quickly calculate the adjustment. Since this is 2020 acquired, we won't be doing that. And so real quickly, you'll see the first year deductions are $135,000, net present value of $32,000, which is significantly higher than our preview. I believe it was $14,000 to $22,000 in our preview. So again, the preview is taking a very conservative approach, and we're always wanting to make sure we never overpromise, and we're always under promising and over delivering instead. So you'll see here's when you export to PDF, here's what you'll see. And also, you'll get the property details, all the information that was filled out and how it was filled out. You'll get that as the export as well. So let me jump back in to the presentation here. Okay, so here are some examples to get an idea of the benefit. Generally, you will notice that the higher the depreciable basis, the higher the benefits from the study. The place and service date also has a big impact on increased deductions in year one or collectively in years 1 through 5. So I always recommend that you take advantage of the built-in tool for previewing the tax savings to see if it likely makes sense to proceed with the study or not. I've included some screenshots of the RCS survey we just looked at and the typical RCS results here in our presentation, just for your reference later if you're printing out this slide deck. So now let's talk about retirements and partial dispositions. The current regulations allow you to take a loss deduction when you remove components from your building. So for example, if you paid $50,000 to replace all the HVAC units in your building, you will need to capitalize that amount and recover it through depreciation over 27.5 or 39 years. You will also want to figure out how much of the old HVAC system was not fully depreciated and claim that amount as an immediate deduction in the year this occurs. In the subsequent slides, I'm going to show you a tool that can be used to figure out the value of any building component without having to do a cost segregation study. Prior to that, I want to go through a case study to show why it's important to figure out this value. Let's look at an example to see the impact that this would have. So suppose a taxpayer acquired a building 3 years ago for $5 million. This year, they spent $1 million to remodel part of the second floor. So for example, ceilings, walls, lighting, plumbing, and etc. We analyzed the original cost of the demolished components and discovered they represent $470,000 of the original $5 million building basis, that is. The taxpayers can now recognize a loss of $430,000 in the current tax year, which is the original cost basis less depreciation already taken. Remember, you can only take advantage of this partial disposition in conjunction with a timely filed return. Otherwise, you forgo the opportunity to recognize the retirement. Based on the final disposition regulations, there are a couple ways you can determine the remaining basis of a component that's been removed from a building. If you've had a cost segregation study done, which has already identified the basis in the component, then you're all set to calculate how much depreciation has already been taken and what the remaining basis of the component is. But if you do not have a cost segregation study, there is a way to calculate the original basis using the producer price index, or PPI. Basically, you can discount the current replacement cost new of the asset back to the date the asset was placed in service. If the asset was not new at the time it was placed in service, then an additional adjustment also needs to be made to recognize the asset's condition when it was acquired and placed in service. However, a word of caution, this method can only be used for restorations, not betterments or adaptations. This makes sense when you think about it, because if you're changing the use or improving the quality of the asset compared to the original component, then the cost will not be an apples to apples comparison to the original that was replaced. KBKG has created an online partial disposition calculator that's available at the link shown on this slide. So let's go through an example of why the condition of the component needs to be considered when using this discounting approach for determining original basis. Suppose a building was acquired 3 years ago and the owner spent $200,000 to replace aluminum windows this year. We can use the PPI index to discount the current cost of the windows back 3 years. Using this, the windows would have been $186,000 when replaced 3 years ago. However, this represents the cost of brand new windows acquired 3 years ago. We need to make an additional adjustment to recognize that the windows were not new when the building was acquired 3 years ago. One way to do this is to consider the normal expected life of aluminum windows, which is 20 years. Since we replaced the windows 3 years after acquisition, we might assume that the windows were effectively 17 years old. An appropriate condition factor using this rationale is 20% or 27%, which results in a value conclusion of about $50,000 for the windows at the time of acquisition. For further discussion on this topic, I encourage you to take a look at the BNA article referenced on this slide. Now, we will move on to the live demonstration of the KBKG partial disposition calculator. And we don't have much time, so we'll make it a little snappy. So back to the home page. Under software, we're going to see partial disposition calculator. Again, you have the ability to estimate your savings, but instead we're just going to jump in right to the calculator itself. In our dashboard, we're going to hit partial disposition calculator. Cost of new component, I think we said 200,000. Date of replacement, let's say 22, 14, 16, 2020. Okay. Original cost basis, we said it was $5 million, right? The date of purchase, it was 3 years ago, so let's say 2/16/2017. You can also just use a calendar if you'd like. Building was originally constructed, you know what, let's say 1970 was constructed. So next up, you're inputting the accumulated depreciation on the $5 million basis, right? You do not know how much the windows have accumulated in depreciation, but on the $5 million, let's say the federal 3 years ago, you know what, let's say like $70,000. That's a federal. You can also input state or federal AMT, state AMT. We're not going to do that right now. So next up is type of component. You can either do a search or you can use a drop down, as I like to use. So we're going to do is we're going to go to, let's see, doors and windows, aluminum, right? That's what we said. Okay. And you'll see 20 years normal life and calculate. And it's that easy. Your deduction is $60,000, right? So basically, your PPI adjusted cost of the component, not considering the condition when you bought it, was $191,000. What that means is the $200,000 that you spent today, you would have spent $191,000 3 years ago. So factoring in the condition, that brings it down to $61,220, less how much depreciation has already been taken, which is the $857, right? And that's your deduction, 6363. You can export to PDF if you'd like and get all this information in there, but that's really how simple and how easy it is to use. Okay, so I've also included screenshots for the partial disposition calculator in case anybody likes to download these. Okay, so as I bring this webinar to conclusion, I think it's important to mention there are significant differences among cost segregation advisors in the marketplace. Sometimes tax preparers aren't immediately aware of how those differences may impact their experience. It is important to use a ASCSP certified member to oversee the analysis. Ask to see the resumes and bios of the key people who are actually involved in the analysis. Do they have the experience and credentials necessary to produce a compelling and credible report the IRS will accept? Some taxpayers need to consider the bench strength of their provider. If you need multiple properties examined and tax deadlines are looming, will the provider be able to deliver high quality results in a timely manner? Will the advisor be around in a few years from now if you happen to get audited? Will they be willing to support you in that audit? Will they charge you for that support, or do they stand behind their work with free audit support? Does the advisor demonstrate thought leadership in the marketplace? Are they up to date with current tax law and trends? Are they aware of property tax issues, energy tax incentives, repair versus capitalization regulations, and etc.? Make sure you choose a firm you can trust to help you maximize the tax benefits of owning real estate. Thank you all for joining me today.
Our presenters' information could be found on this slide. If you have any questions about the material that was covered or would like to discuss an opportunity, please give us a call. KBKG offers other webinars that may be of interest to you. I invite you to check them out at kbkg.com/webinars. For those that want to know about the pricing of the tools used in today's demonstration, the partial disposition calculator is available for $49 for 24-hour access or $449 annually to use it as often as you like. The residential cost segregator tool includes free audit support and is only $3.99 per report. We also have discounts available when multiple reports are purchased at once. Please reach out to us if you have any questions about pricing.